If you're like a lot of people out there, you may have gone shopping for a mortgage loan before. You may have even realized that depending on the lender that you talk to, the day, the mortgage rates can be completely different every single day. So let's talk about exactly why that is the case. Now, first, my name is Jerry Kindig. I'm a mortgage broker. I actually do this for a living. So I shop over a couple hundred lenders across the country to make sure that my clients are getting the best deal for their mortgage. I also teach other loan officers how to do this job too. So I know exactly what I'm talking about here. So, first thing we have to talk about when it actually comes to deciding what rate you get is the connection with the market. Now, this doesn't mean you go and you look at the Federal Reserve rate and you find out what the Federal Reserve basis rate is, because that's not what controls mortgage rates. Even yesterday, we saw the Federal Reserve say that they were going to drop their basis rate. And weirdly enough, mortgage rates went up today. So the real market connection that you see is the buying and the selling of mortgage backed securities. If you've seen The Big Short, you may have even heard that term before. Maybe you've just heard it in general conversation, seen it online. Really, all it is a combination of a lot of people's mortgages that investment companies buy and sell to be able to get returns. And generally speaking, if the price of mortgage backed securities goes up, the interest rates go up too. If mortgage backed security prices are going down, mortgage rates are going down. You can also track this by looking at the 10-year treasury, because you can't actually see the buying and selling of mortgage backed securities because we just don't have that access. The general person doesn't have the funding to be able to go and see those prices. So go check the 10-year treasury. Now, second thing that we're going to look at is the lender and loan level price adjustments. Now, in this case, the only thing I want you to think about is think about risk. How risky is your loan? If you have a lower credit score, if you're putting very little money down, maybe you're even using down payment assistance, if you're purchasing a condo versus a single family, if you're doing a 30-year loan versus a 15-year loan, your loan is more risky, you're going to have a higher interest rate. If it's less risky, well, just the opposites of all the things I just said, that means your interest rate is going to be lower. So, one thing that your loan officer, this is something that I do myself, is that they should always be giving you other options. They should not just be taking exactly what you say you want to do, because based off of your loan, you might be able to get a better interest rate if you can change the terms up a little bit. So you need to be working with somebody, if you're getting a mortgage loan, that knows what the loan level price adjustments are and how to get you a better option. And how do you know if you're even getting the best option possible? Well, you might want to work with a broker that shops over 200 lenders across the country, because every single lender always has different adjustments and different rates. So if you want to check me out, you can go to my website there, pickmymortgagerate.com. You can see exactly all the programs that we have. You can see our interest rates fully transparent to you every single day. Hopefully we'll get to talk to you soon.